thanks so much for joining us today for our expert interview. And today we are speaking to Greg from Fizz Accountants, and he is expert in all things accountancy. So welcome, Greg. Thank you very much for joining us.
Thanks for asking me.
That's okay. So I have obviously put questions out to my audience, and I've got, I've put a request for questions out, and I've got some requests of things that I can ask you. So I guess I'll just kind of share the questions with you, and we'll just have a conversation around it.
Fire away.
Good. Okay. So first question that came up was, when should you consider being a limited company?
It's a lot less important than it used to be. So a few years ago, the tax regime was quite heavily tilted in favour of people who work for limited companies. And it wasn't by design, it was just accidentally evolved in that way. And then about 4 or 5 years ago, there was a new increase in taxes on people like me who earn their own income through a limited company, which has cost me a lot of tax, but which I applaud very much. It's very fair. And that means that basically the equivalent tax rates for company owners and sole traders are pretty similar. So for the coming year, somebody who's a sole trader, their tax and NI in basic rate is going to be about 30%, and then in higher rates it's about 43%. If they have a limited company and they take money out in the sort of in a robust and measured way, then the blended tax rate then the company are going to pay is going to be 26% instead of 30%. And in higher rates it's going to be 46% instead of 43%. So in one band it's a bit lower, in one band it's a bit higher, but you're probably going to pay your accountant more. So these days, for year on year profits, it doesn't really make that much difference. The tax reason it might make a difference to some people is that if you make £80,000 this year as a sole trader, you will pay tax on all of it. Whereas somebody who doesn't necessarily need the money in their life right now and wants to push it into future years, might leave it in their limited company and not draw it out yet. Like we usually call that sheltering. So somebody who wants to defer profits to a future year, limited company could be quite powerful for them.
Right.
But I would say in essence, we've kind of gone back to the old system where, you know, limited liability, that might be the biggest reason somebody thinks of having a limited company, i.e., you know, if things go wrong, you don't lose your house. But nobody is going to look back and think, oh no, if only I'd formed a limited company, what a mug I am. It's fine either way, and having a good business is the important thing.
Okay, and so a question did come up actually with someone that's starting to exit and starting to kind of wind down, and there was a question about, well, when, you know, is there a time where you would actually revert from limited and go back to becoming a sole trader? Would there be any good reason for doing that?
Yeah, I mean, I don't think so. 5 years ago, we would have probably advised 90% of new clients we met that a limited company was appropriate. Now it's more like 50-50. Right. We haven't got a single client, I don't think, who's come out of their limited company and reverted to or begun being a sole trader. Because when it's not that people are worse off that way, it's just that they're no longer cleaning up in the way they used to.
Okay.
The trigger, I suppose, might be, it's silly to make decisions based on future tax arrangements, but at the moment it's scheduled that corporation tax for some limited companies, basically ones with profits over £50,000 a year, will go up quite sharply in a year's time, in April 2023. But maybe at that point, some people might think, well, hang on, actually, I like the sole trader tax regime a bit more now. But at the same time, what we don't know is what will happen with sole trader tax rates, and we don't know if that change will be reversed. So it's silly to plan for what you think will happen in a year's time. And if somebody's thinking of like selling their business or preparing for sale, I'm not sure the format matters that much, because I mean, quite often, even if you've got a limited company, the buyer's not going to want to buy the company necessarily anyway. They might want to buy what's in the company. So it might be either way. What you're basically selling is, you know, a client list and a lease or whatever. So yeah, again, I think I've never come across a situation where somebody has sold their business and it's been catastrophic because of how they were set up. You know, again, making the business desirable for somebody to buy, that's where the battle is. I think.
Yeah, I agree. And so then in terms of recommending your clients around calculating tax and you know, putting it into a pot, what do you recommend that they do with that? And then I suppose linked to that question is, do any of your clients use the profit first system?
So I skimmed the Profit First system before because a client mentioned it to me 4 or 5 years ago. And I think it's one of those things where somebody's taken some pretty established concepts and said, oh, here's a system, and put a name on it. But they are good concepts. So like we call them different things, but a couple of things are like at the core of what we'd advise. So I think the Profit First idea, I mean, you'll correct me if I'm wrong for my 5-year-old skimming, is essentially what we call like looking at your business bottom up rather than top down. And we always say to people, okay, well, rather than thinking, okay, well, this is how the business works and I get whatever happens to be left at the bottom, just think, okay, well, hang on a minute, why am I doing this? And if, for example, if somebody says, well, I want £45,000 a year net in my life for my limited company or whatever, you might say, okay, well, fine. So that's going to mean probably £40,000 of dividends. And that's going to mean £10,000 of corporation tax before dividends. And that means, fine, we need £50,000 of profit after the overheads. And the overheads are probably going to be £25,000. So we're going to need £75,000 of gross profit. And if the clinic owner isn't working and just has associates on a 50% profit share or something, say, okay, fine, we're going to have to get £150,000 through the tills in order to feed, me at the bottom.
Yeah.
And then if you think, well, if you can't do that, then you have to either make your business better or you have to make your life worse. Those are the those are the two ways you can go.
Yeah.
So Profit First is what we advise people all the time, is to think about, that aspect. It can be harder with like clinics and therapists sometimes because people didn't get into it necessarily to make a lot of money, but it's still necessary to make enough money for you to be fulfilled.
Yeah.
And your customers would tell you that as well,
Yeah, and I think that is definitely the trap that a lot of small businesses, maybe not even just therapists, but small businesses in general, will fall into, where they kind of think, oh, this is a great idea, I'm going to set up this business, and well, I need to get sales through the door, oh, well, I need to pay for all this marketing, and I need to pay for this and pay for that, and then suddenly, oh gosh, I've got £500 left to pay myself.
Yeah, exactly. Yeah, and it's far from uncommon for. Very often the owner of a business is not necessarily the highest paid person in the business, and that might be fine. That person might be working 10 hours a week and be quite happy to not be earning quite as much as the highest earning person. But at the same time, there are businesses that I know of, not clients, where people look from the outside and say, well, what a fantastic business that is. Well, but they're cheating because the owner's not making any money. They've got some money elsewhere. It's easy to have a great looking business if you're not making any money yourself, or easier anyway.
Yeah, completely. And that is definitely, that's one of the exercises that I get my clients to do, is actually work out what the hourly rate is. So they might say, well, I only work 2 clinical days, but you're working 4 days on the business, you're working at night, you're kind of chasing things in the evening, once the kids have gone to bed, you're back on it. And so count up all those hours and then tell me if you're really happy with your remuneration.
Yeah, no, absolutely. And in the same way, some people who are employed, I think, might find it interesting if, rather than thinking, well, I get paid X pounds an hour, they added on to the hours they spend traveling, and they deducted from their salary the money they spend traveling, and then deduct the lower amount of money by the high number of hours. And a lot of people aren't doing quite as well as they think they are.
Exactly.
Yeah. So focusing on profit that's at the core of what we talk about to people at that, really. And the idea, I think, another key thing in the Profit First system is like what's usually called pay yourself first, which we always preach. I get paid at the end of each month, as everybody else does at FIS. Start of the next month, a bunch of the money leaves my current accounts to go into like ISAs or pensions or whatever. So that's a great principle. And I mean, with a limited company, if you want the tax efficiency to be robust, you've kind of got to do that anyway. You've got to pay yourself in a disciplined way. But even with sole traders, we strongly encourage them to pay themselves a wage, because most people, including me, would not cope well with having all of their money in one place all of the time.
Yeah. Yeah. And I think, just kind of a lot of the time what I see is with sole traders, that they just, everything just comes into the same account and it's all there, and it's all a bit of a mishmash, and at the end, and then they get a bit of a fright when their tax bill comes.
Yeah, exactly. It could be a shock, because sometimes they've got a shock when the tax bill comes because they've saved up far more than they need. I mean, that can happen as well. The point is to have a plan. And I guess probably the bit of the, as I recall it, the profit first system that I think is probably less necessary is the idea that you would like take money and put it in a bunch of different pots for different taxes and purposes, because I think usually if somebody's kind of internalized the main thing and designed a business that can, where they can draw what they need without stressing, kind of by definition, what's left should be enough for all that stuff. Like we often use the metaphor of the money in a business being like a kind of reservoir, and the profits are coming into the reservoir, and you're draining money out of the reservoir for your personal life. But as long as you know that you've designed a system that works okay, there's no need to then get stressed and get a bucket and say, well, I better take some of this reservoir out for my corporation tax and put some of it here. It becomes less necessary at that point.
Yeah, I get what you're saying in terms of the understanding. And I suppose with profit first principle is almost that helping people with that cash management. So I had a particular client that came to me because his opening statement to me was, I think I need help. The HMRC have taken my deposit for my mortgage. And I was like, okay, yes, I think you do need help in just understanding the business, never mind even the practical elements. But practically what he has now got, he's got a separate account, so you can't see that tax money, and the tax money is there, and it's really served its purpose for him. So I can see the pot principle working, but I completely agree with you that you need to understand the principle behind that in order for it to work properly.
Yeah, I think that's the thing. Just doing that it gets you some of the way, but actually thinking about, okay, well, hang on, what profit do I need? Not what profit can I manage with, but what profit do I need if I've mapped out the finances of my life for years ahead?
Yeah,
that's the most important thing. Yeah, I agree. So it's a good system, is right.
Yeah, no, I think I've definitely seen it help clients. And it's almost even just that they're now consciously looking at their money, even though they've suddenly decided to look at it because here's a framework that I can look at it within, and suddenly realizing, oh, actually, I'm not collecting my debtors quickly enough. I'm not invoicing people quickly enough. So, I've got clients that work with case managers and insurance companies, and so they're not getting the invoices out quick enough. They're not following through the process. And suddenly at the end of the month, they don't have enough cash flow to pay salaries. So the profit first framework, I suppose, has made them realize what else isn't working in their business as well.
Yeah, that's right. I mean, broadly speaking, you get businesses that quite often when people say their business has got a cash flow problem, actually it's not a very good business. But sometimes there is a cash flow problem, because if you have to pay your costs in advance of customers paying you, then that makes cash flow harder. And somebody who's very exposed to insurance companies paying bills, but has to pay the stuff right now, they could conceivably have a cash flow problem for sure. But it's you need the information to know exactly what the problem is so you can address it.
Exactly. And so what key numbers should one know about one's business?
I would say quite often that might flow out of the exercise of thinking about how the business should look. So, I mean, I think in a lot of businesses, you might get down to just one or two key numbers. I mean, in our business, for example, I'd say like the monthly revenue is the key number, because like many other businesses, our overheads are pretty stable month by month. Most of it is salaries, a bit of it is rent and software and all that kind of stuff, but that doesn't really change very much. My business partner Jane and I draw money out on a monthly planned basis, which, by the way, is another thing that helps people not take money out of their business left, right, and centre. If you've got a business partner who's going to see, that kind of keeps you honest.
Yeah.
And that means that essentially, when we go bottom up, we know that there's a number where if we invoice that in a month, that's going to keep our reservoir level. We know that if there's more, like January, we'll be able to chuck a load of extra water in the reservoir. There'll be months where we're below that, but we know in general that we just need to be above it more often than we're below it for like the profits of the business. So that's the one thing, really. I mean, I don't care too much about a lot of the other overheads. I only care about the salaries, in terms of I want people to be fairly compensated, but I'm not going to get obsessed about marketing spend or something, which is probably zero for us anyway. So I think quite often there's more to, and I bet for a lot of your your clients, that monthly revenue figure might be quite important too. And you might, if you're running a clinic, you might be able then to go from that and say, well, actually the key metric is not a number, but it might be like the percentage of room usage or something. I don't know. Maybe
absolutely.
So you could know, fine, if the rooms are in use 85% of the time, that keeps everything topped up. If we fall below, then we need to address it.
Yeah, and then other numbers like measuring the average fee per patient. So, you know, if that starts dropping, then we've got to say what's going on here. Have you tipped over the, you know, over the edge of too many insured patients, not enough self-paying patients? So so they're quite, you know, they're numbers, but I think I'm an advocate of trying to get as, you know, focusing on as few as possible so that you can really make an impact on those. And when you're focusing on one, the others will fall out of that as well.
Yeah, absolutely. And I think also if you've got some specific things to focus on, that stops you from getting distracted by relative trivia. There's a thing that we could quite often refer to as like telephone bill syndrome, where you're looking at accounts and somebody be quite fixated on like the mobile phone costs having gone up from £600 to £800 in a year or something. But you know what's important really are the dividends and the revenue and the associated costs and the salary. You know, it's the big numbers are the things that are important. But if you don't think about that, then I guess you might instinctively just treat every number as being of equal importance.
Yeah. And this always comes up. I was having a conversation with a client, and we're talking about priorities, and actually the word priority, the origin of the word priority, Latin origin, I think it was Latin anyway, was always singular. It was never ever meant to be a plural letter. So it is so kind of what is a priority to be monitoring. Yeah. And so how often do you recommend people meet with their accountant? So I know I've got some clients that don't ever see their accountant and they just post their bills and that's it.
Yeah, I mean, it's an interesting question because I haven't got a one size fits all answer for that, because it depends. Because it might be if you've got to the position where you think, yeah, I know how this machine works, I know how to keep it oiled, I know what needs to come in, that it might not be that you have to then like have a quarterly meeting or Zoom with your accountant or whatever. You know, that's completely fine. And I can think of one client we have where we do have regularly scheduled meetings, but occasionally it does feel like, well, hang on a minute, we're just talking a bit, we're talking about the same things. It's not really being absorbed. So maybe actually we need to find a different approach. And then I was thinking of another client where we had quarterly meetings for like 10 years. And, you know, we've had one or two where I've said virtually nothing and thought, oh God, they're going to think I'm not really delivering here. But actually they say, what a great meeting that was, because it's kind of just it's a trigger for them to talk to each other. I don't know, maybe you have appointments like that as well sometimes, where you get to sit quietly and the person thinks you've done a good job.
Yeah, but
I mean, quite a common model for us is like setting out regular figures that are kind of just annotated. So rather than saying, here is your profit and loss account, saying, okay, well, yeah, here's your profit and loss account, and here's a key to the 4 things we've highlighted and what they mean and what you might like to reflect upon. So I think there are some businesses maybe every quarter, but it's rare.
Yeah, but it's the act of reflecting on your numbers. So, you know, if you've got that kind of meeting, or even if you're just getting your management accounts once a month, but you're actually regularly looking at them.
I think that's the thing.
And questioning, you know, asking what you don't understand.
Yeah, exactly. But I think having a trigger for, you know, actually reflecting, that's very important. And in the same way that, you know, people probably could go to the gym if they didn't have a personal trainer or a gym buddy, but the commitment makes them go. Maybe the commitment to a quarterly meeting with an accountant might force your hand, perhaps. So there's no one size fits all answer, but
that's okay.
Depends what you try and get out of it.
So we've got sometimes scenarios where people are paying for packages of care. So let's say they pay for a package of 6 treatments, but they have them over a period of 6 months. How should that be accounted for in your books?
So that is something accountants call the accruals concept, or cut-off. And the answer to that is that if 3 of those appointments are going to happen before the year end and 3 of them are going to happen after the year end, then half of that income gets pushed into the next year. So we'll go through an exercise with clients in all industries at the end of the year where, like, before the year end's coming up, their client manager will get in touch and say, right, amongst the things we need you to do, we need you to think about things you've invoiced but haven't done and things you've done but haven't invoiced, because it works both ways. You know, if you do a load of sessions for people in the last week of March, but for some reason you don't bill the insurance company until the 1st of April, so I don't know how it works in detail, then that would be pulled into this year. And in part, that's because you're trying to make the accounts useful. I mean, that's the thing. It's a rule based on the accounts. Yeah, it's nice that you can use accounting records to do, you know, year-end accounts and tax returns, but the fundamental point of accounts is to help you make sure you're not wasting your life. And so even, you know, in year, you might do that exercise to, you know, try and figure out each month and know how much value we're really delivering. Don't care so much about the cash. The cash flow has to be good enough, but what matters is who was in the rooms being treated and how much will we be paid for that in the end.
And I think also, just in terms of, say, packages and things, if they are selling quite high value packages, I think I have seen clinics get into a bit of hot water where they're getting all this money in, and suddenly their judgment of whether they're making a profit or not is looking at how much money's in the bank account, and decide to go and invest in this and invest in that, and then a few months down the line they're not getting that money in, but they're having to deliver that service. So
yeah, absolutely. I mean, and if it's a company then using the money to invest when you haven't really earned the profit, it might be unwise. If you use it to pay dividends, then you've actually broken the law, you know, because it's profit first, not cash first.
Yes.
So it's just as you can have a profitable business with no cash if people are very slow paying you, but you can have a business with a bunch of cash in it that hasn't made any money. That's a thing as well. So, and that's
I think that's something that. Yeah, I think that's something that some business owners aren't even aware of, that they not allowed to take dividend if the business does not have the profit in the business.
Yeah, absolutely. A dividend is a business paying out profits after having put the tax to one side. So if that hasn't happened, then they can't pay a dividend. But again,
and that's where I think sometimes that's where I think the profit first system, the bank accounts, even if you've just got a tax bank account and you don't have the others, at least starting with that tax bank account where actually you're putting that money in there, so it isn't part of this lovely, delicious looking pot that you can go and buy shockwave machines and, you know, the latest and greatest technology for your clinic without knowing if you've got that profit or not.
Yeah.
And so when should a clinic look at having an accounting software system rather than a spreadsheet?
So, I mean, in the case of a clinic, I would say probably always. I mean, so the key difference, I mean, really, people often think, oh, account software is a glorified spreadsheet. I mean, it isn't, it's a database. So, I mean, one thing is it just gives you some integrity that the records are right. Like whenever you read about some big accounts problem, like, oh, some accounts have had to be restated by, you know, the BT pension fund was out by like £1 billion or something, wasn't it, at one point? So, you know, whenever that happens, we always say in the office, that'll be because it was done on Excel. And it is always because it's done on Excel.
Yeah.
So, and there's not, unless you build it, there's no integrity check. You know, you list everything out and then your formula misses something out.
Yeah.
Or, you know, you put some numbers in, but there's nothing that proves that matches the movement in the bank account over the year.
Yeah.
So we always say to people working here that the jobs that can most easily go wrong in terms of misleading numbers and incorrect profits and taxes, they're the Excel jobs.
Yeah.
With software, it doesn't happen.
Yeah. Yeah.
And the thing about it being a database is that you can use it to, you know, find out interesting information. You know, if you're thinking with a spreadsheet system, I feel like I've been spending more and more on this type of cost over the years, then, I mean, you can find the information in your tabs there, but it might take a little while to assemble it. Whereas if you've got some software, you can go click, 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 click. Oh, okay, fine, you know, because you're reporting on a database. And also your accountant can go and have a look as well. So if you're an exercise that happens for us in the last couple of months of the tax year, as we are now with like limited company clients, is their client manager will like check in with them based on how things are going, their profit extraction. Maybe there's a bit of room for them to take a bit more than they thought they would be able to in a tax efficient way. And the great thing is that we can just look at the live data, and if it's up to date, we can run a profit and loss account, see how things are going, you know, run it, click, 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 make it month by month, see how they're doing in terms of the kind of the target monthly revenue figure they were working to. That's what, you know, what's about software really. And the other thing is that to some degree the choice might be taken out of people's hands quite soon, because we're going through this process called Making Tax Digital at the moment, which mandates at the moment, so VAT registered businesses, so a lot of clinics will escape this at the moment, but VAT registered businesses now have to submit quarterly figures to HMRC digitally. And you can do that by keeping a spreadsheet and then having another tool that looks at the spreadsheet and reports to it, but it's a bit amateur hour. And so most businesses really are going to have software to do that. That's coming in, I think, April 2024, Making Tax Digital for income tax. And at that point, any business that's not really just a side hustle is going to have to report digitally. So at that point, and what will happen is businesses will go onto software and they'll think, oh God, why didn't I do this ages ago? It's really good. I wish my accountant was to do it.
Absolutely. And I think also sometimes people will look at the price tag of Xero or QuickBooks or Sage or whichever one they decide to use and think, oh, you know, that's quite expensive. Excel's free, but it's not free because there's so much more effort. I know that there's a setup and stuff with the software things, but once it's set up, the administration of that is generally a lot quicker than capturing things in Excel and the avoidance of mistakes, as you say.
Yeah, exactly. And it's, I mean, and they're just not, I mean, it does cost more than Excel, but that's because they're different things, basically. And it doesn't have to be much. I mean, Xero Starter is fine for all, I think probably all the clients we look after, if they're using Xero, it'll be Xero Starter. It's £10, £12 a month or something. It's, it doesn't cost very much. I think if a serious business, a clinic that wasn't on spreadsheets, the first thing we would say is, well, you're going to have to go into software, because otherwise, if you want us to add value to what you're doing during the year, you need to keep information that somebody can look at and reflect upon.
Yeah, and it's all kept in a tidy space. So obviously with Xero and QuickBooks and Sage and all of them, it allows you to have most of your records electronically now. So, you know, so if you have any bills, so like if I went to Manchester last week and have, you know, the taxi fares, get the little piece of paper from the taxi man, take a photo up into Xero and it's gone. Can I throw that piece of paper away then?
Yes. Which is good for me because I'm horrible at keeping receipts. I mean, the thing is, actually, technically, the rules around keeping receipts and purchase invoices and stuff, they're actually VAT rules. So again, a lot of clinics aren't actually going to be affected by that. I mean, it's still, if there's an income tax inspection or a corporation tax inspection, and the inspector, which is like quite rare these days, but if it happens and the inspector says, well, I don't believe you spent that much on travel, I mean, it's nice to have a paper receipt. It's nice to have a photo of the receipt. They're of the same value. You might have a line on a bank statement that says cost of coffee, £2.90. I mean, you know, what does the inspector think that was? But it's fine. I mean, in our case, our practice accounting is on Xero. Like PDF purchase invoices get emailed directly into Xero. There's a good capture function, so you don't have to attach, you know, if it does OCR and creates a draft bill. Photos of receipts when I'm in a cafe or something, I'll take a photo and then stick it in the files area of Xero, and so it's there if we need it. So we have no paper invoice files for sure.
That was definitely.
So I was going to say that also. Sorry.
That's okay.
You go.
I was just going to say having not have to keep paper files was amazing.
Yeah, and the thing is also you then don't have to think, oh, when can I get rid of this file or when can I get rid of that file? No, who cares? You know, it's not, you know, it's not like you've got a firebox in your attic anymore with like shred in 2022 written on the top. It's just all in the software, and you're not going to be concerned about deleting the old stuff unless you're particularly worried about something, I guess, that happened.
And so one of the phrases that obviously gets spoken about is break-even point. So, well, what is it and how do you work it out?
Yeah, well, I mean, if you go back to, I guess, I'll chat about profit first, again, it's a kind of aspect on that, isn't it? Because there's no, I mean, the break-even point is the point, I would say, when the reservoir is remaining level.
Yeah.
And there's no, I mean, some people might say, oh, it's the business, it's the point where the business stops making a loss and starts making a profit, which is all very well, but I don't think that's very helpful because you are part of the business. So to us, our break-even point is that monthly revenue point where we are breaking even when taking into account the expectation of the owners in terms of the money they're taking out. Exactly. And again, so going back to that example, what did I end up with? £150,000 or something, didn't I? So you might be thinking, fine, £12,500 a month of gross revenue. That is our break-even point because it leads to profit after tax of X, which means like necessarily there'll be some businesses that for some people are great, and for some people are wholly inadequate, and it's the same business. You know, if I want to take £600,000 a month, a year out of this business, it is not a very good business. If somebody's looking for, if somebody wants to take £15,000 a year, they'll think this is an amazing business.
Yes,
it's the same business.
It's perspective, isn't it? Yeah.
Yeah.
Okay.
Yeah, does that make sense? I don't know. Perhaps I've got a different perspective on break even than some people have. I'm not sure. It's a long time since I was at accountancy college.
Yeah, I mean, I kind of look at perspective just in all sorts of things. You know, perspective is also if you want to retire in 10 years' time and you want to have a lifestyle where you are, you know, traveling the world and playing at the best golf courses, staying in the best hotels, you're going to need a lot more in your financial retirement pot than you're going to need if you want to retire in 10 years' time and you want to be down at the coast. You don't want to have to drive anywhere. You want to just be able to spend time with your grandchildren and, you know, just have a really simple lifestyle. Neither are wrong. It's just your different desires, and therefore your pot needs to be different. So just the same as your break even.
Yeah, exactly. And I think an interesting exercise with that kind of thing is, to think in terms of future years. Okay, well, if I take into account this business for now, and then the bridge between that and actual retirement and pensions and ISAs and stuff, and how much I expect to spend, you know, how is that balance working? Because I think, I mean, there are a lot of people who haven't saved up enough for the things they want to do. There are some people who are saving up too much because they've not thought about it. We tend to assume that you kind of accumulate money through your working life and then you start decumulating it once you're retired. But that doesn't have to be the case. You know, there might be stuff that you really want to do right now that you'll get the greatest value from in your life right now. In which case you should go ahead and do them, knowing what's coming in the succeeding decades.
Yeah, completely.
So again, no business is good or bad.
The kind of thing about money that we talk about in terms of, do you, what are your kind of money beliefs? Do you believe that it's difficult to attain money, or do you believe it's difficult to retain money? But then the part that you've just spoken about is, do you believe it's difficult to experience money? So there are people that accumulate all this wealth, but they so kind of in their heads thinking into the future that they need to have this pot of money at the end, that they're not enjoying their wealth in the journey.
Yeah. And there are people who go to their grave like still accumulating wealth, you know.
Yeah.
And you think, well, what a shame.
Yeah.
And even if they think, oh, well, I want to leave a lot of money to my kids, you think, well, could have given them to them a bit earlier, couldn't you?
Yeah. Enjoyed it a bit earlier. Yeah, exactly. Are there any typical ratios that one should measure in your business? So like percentage of staff costs or marketing spend, or and I know that's probably like a how long is a piece of string question.
Well, no, it's not necessarily, because there are models, but obviously they're not necessarily models that you would try to say, well, I need to be like this. They're just probably models where you'd think, okay, well, I'm different from this and I'm comfortable with that, and here's why. So in like professional services like accountancy and law, and probably things like these days like web agencies and animation studios and stuff, there's always been this kind of idea of a third, with the idea being of the money that comes in, a third of it is for the wages, a third of it is for the overheads, and a third of it is for the owners.
Okay.
And we don't fit into that because we're such great people. We pay more than a third to our staff. we probably paid a bit less than a third in overheads. But the point is, we look at that and we think, that is what we are trying to do. So we kind of, it's not that salaries are out of control. It's just that that's the way we've designed our business to work, and that's fine. Yeah.
And
exactly. It's the same. It's the same. No, carry on.
Sorry, we just got a bit of a lag in the signal here, I think. I think like with clinics, often the percentages, especially if they've got self-employed associates, the percentages can be quite weighted. And almost, so you might look and say, well, I'm quite happy, I feel comfortable paying my associate 60%. But then we look and say, well, but you're not feeling comfortable, you're only taking 10%. So where do we need to redress this balance?
Yeah, you're not going to get a third if if the associates are getting nearly 2/3. I mean, on the other hand, maybe you're kind of hands off and not really doing any work, and the thing is churning out a couple of £1,000 a month to you with you barely lifting a finger.
Yeah.
In which case it could be fine as a design, and it might be that if the overheads are the same, you'd love to have like loads of associates fully occupied, paying you getting 60% than a handful of people who are only getting 40% but they're not occupied. So it can depend on volume at the top as well, can't it?
Yeah.
So so I think clinics are probably pretty similar, but although I think it's probably a bit more challenging than them if they're committed to paying a very high percentage to associates.
And that landscape is changing because it's moving from self-employed to employed, and so the landscape is starting to change a bit, and I'm starting to see a little bit more kind of 45% paying out, and the clinic keeping 55%, which makes it a little bit more of a sensible business model. But I suppose the moral of the story here is actually interrogate those percentages, have a look at what those are, and are you then happy with that? Suddenly if you look and you're spending 20% on marketing, but you're not getting the input of new customers, then we've got to say, well, what's that investment of 20%? Why are you spending so much money?
Yeah, exactly. I mean, I think there's sometimes this idea that accountants are going to tell you need to cut costs. I mean, not at all. I mean, if something's making you happy, great. If something is generating more profit, great. Sometimes you want to do more of a thing, not only with marketing. If it's working, you do more of it. I remember talking to a client a while ago. I said, "Oh, how's your business coaching going?" And they said, "Oh, it's really great, but we're having to cut the sessions in half because we can't afford it." And you think, okay, well, is it going great? If your idea is getting more money, profit in the business, then it's not going great. Yeah. Whereas if it is going great, you might double the number of sessions. So I don't think there's any correct thing. But again, going back to having account software, the point is you've got the information, because a way I often think about it is if there's things in your year-end accounts that are some kind of news to you, then I would say that's a system that needs to be changed. Because in our case, I can tell you the bigger a business is, like, funny enough, the less discussion there is of the year-end accounts. You'll want, because there's no news in there. They had like regular figures through the year. They knew what was going to happen. You'd be amazed potentially how often, like, the sign off for like a company turning over a couple of £1 million, the meeting might be, we talk about a load of other stuff, and then it's, oh yeah, we better sign these accounts, haven't we? It's that, it's that level. So it's just figuring out, okay, I'm spending this much on this thing. Do I value it enough? And then there's no correct amount to spend on marketing. We spend nothing on marketing, but if we decided to like aggressively try and get more new clients than we're getting, probably we'd spend something on marketing, and then we would monitor whether we thought it was worthwhile or not. So I don't think there's no correct amount. The point is to know the amount so that you can reflect upon whether that's bringing you value, whether value is financial value or just the value of happiness and joy.
Which is a lot to be said for it, which is nice to hear an accountant say that we're not just here to cut your costs. We're here to help you think about them. And then, so one of the other questions that came through was around tax efficiency in terms of buying company cars through a limited company. And so is it better to buy it or lease it or purchase it? And, what's your thoughts around company cars and your business?
Yeah, so it's fairly easy, really. If you have a limited company and an electric car suits you, then it's almost certainly going to be a good idea to buy or lease it through the company.
Mm-hmm.
Making sure you do it properly rather than doing it in your own name, but putting the direct debit in the company's bank account or something. Mm-hmm. I don't care whether you buy it or lease it. It doesn't really matter, because what matters in the end is the cost to the company over its life, over its lifetime. The thing that's going to catch people out is they think, oh, I'm going to buy it because the salesman said in my or I read that I get 100% tax relief on the cost of the car. That is true for this first year allowance where you get, so if you buy this car for £50,000 and you get to knock £50,000 off your profits before working out your tax bill. I think what people might not be anticipating is that when in 2 or 3 years' time you sell or trade that car in, you're going to have to give back some of the tax relief. So that maybe is going to catch people out. Maybe people think, oh, I'll buy it, not lease it because of the 100% relief. It's only 100% relief at the beginning. And you could get a situation where it ends up costing money. So if, for example, you buy that car for £50,000 now in your company, you're going to save tax at 19%. So you save just under 10 grand. And then in a couple of years' time, you trade it in for £35,000. Well, as things are scheduled at the moment, the highest rate of corporation tax then could be 26.5%.
Right.
And giving back £35,000 worth of tax relief at 26.5%, that's another 10 grand. So the thing will have saved you no corporation tax at all over the time. That, again, you wouldn't plan on that basis. But the point is, it's all just timing. What you're going to save tax on in the end is the cost to your company of the car over its life with the company. And that could be a lot of lease payments, servicing and stuff. It could be a big purchase minus a big sale plus servicing and stuff, but it's the total cost that matters. You're going to save tax on both the same way.
Yeah.
I mean, my prejudice would be normally you lease because you haven't got the cash to buy, probably. But I think sometimes there are maybe deals where, at least companies manage to get so many of these things to shift that they're doing a really good deal, perhaps. But it's, that's not so important, really, the method.
Yeah. Well, I mean, those were kind of all the questions that were submitted. I suppose one of the questions in my head, just from our conversation, is, what are the comparison type things that people should be looking at? So in order not to get a surprise, so if you were looking at your profit and loss, I've just heard recently of a group of clinics where the financial director managed to suffer some money out of the business over several years, and quite a substantial amount of that. And so, as an owner of a business, what kind of things should you start being comfortable and understand when you look at things?
So, I mean, in that case, it's probably going to be quite hard to stop a competent finance director of a big company stealing some money if he or she wants to.
Completely, I completely get that.
Yeah, but on the other hand, I would say one big check is does this feel right? You often say to people that the biggest check on accounts can be does this kind of feel like that year felt to you?
Yeah.
And if you say, if you're thinking, oh no, I really felt that we took in a lot more cash than that, then that might be a sign that something's going wrong. So that's the key thing, I think, is just a reality check of, do I think this is realistic? It's hard. I think it's one of these things where if we spent a lot of time sort of advising clients on how to watch out for that kind of thing, in reality, it's one of these things that rarely happens, isn't it? It's just that we hear about it when it happens. So you tend to be in the same way that people tend to think that benefit fraud is rife because there's all these television programs about it, when it's actually not rife at all. I think maybe because we read about frauds, we think, this could happen to me. So does that kind of make sense?
I suppose.
I think maybe this data, sometimes people look at the accounts and they think, I don't understand accounts, I can't look at this. Well, unfortunately, got to.
Just get comfortable with them and spend some time and just ask those questions, I guess. Because I suppose that's the other thing that some clinics really struggle with, is giving giving access to bank accounts and things like that to their team members now. And that's where I think with like having Xero or Sage or whatever, where even if they're responsible for reconciling, they still don't have access to your bank account. They've just got access to the feed that they have to reconcile.
Yeah, absolutely. And well, it's another reason again why software might be a good idea. That even if you have got somebody like making the payments, you can see what payments are being made. You can see what amounts are going out. And if you're keeping like proper, it can only go so long with proper records, because if I decide, oh, actually, I'm going to pretend I'm paying this bill to Celia, but actually I'm going to transfer the money to me, then it's only going to last for a while, isn't it? Because you're going to say, why haven't you paid my invoice? and then I get in trouble. So again, the accounting records are kind of the key thing. I mean, if you're in a situation where somebody is actually, what popular frauds do you see? Creating false invoices. I think I was reading about one of those a couple of weeks ago where the National Trust had been defrauded by somebody who was an employee who was sending in bogus invoices and paying them out. I mean, again, if you at a small business level, I think an owner should be able to detect that if they're just taking a cursory look at the records.
Yeah, and I think that's where it is actually just getting into a habit of looking at your monthly management accounts and going through your profit and loss and just kind of even comparing periods and kind of saying, hang on, why is our stationery spiked? Oh, okay, look into it, and now we can see, well, we bought all these leaflets. Okay, that's not really stationery, that should be in marketing. And just getting that more, just kind of, I suppose, being a little bit more comfortable with the numbers is what I see.
I mean, the checks that you tend to do, I mean, it can be like surprisingly primitive. I mean, really, the key report that we use probably to run fears, or I use, is just that monthly profit and loss account. So, I've got the default report for me on Xero is a profit and loss account for this year, month by month. So I can see, the rent should be the same every month. I should see the salaries. Oh, the salaries went up. Yeah, that's because there was that bonus or whatever. I can see, we spent a lot that month. Oh, yeah, we had a client event or whatever. So, at times I will actually run across it with my finger just to force myself to engage with it properly. And, key check, if I'm reviewing some accounts that somebody else has prepared or somebody else has reviewed, I'm probably going to go to the back of the detailed profit and loss account and run down there like with my fingers just to say, okay, why has that gone up? Why has that gone down? It's not... it's not like you have to figure out how to use pivot tables in Excel.
No, you don't need an accounting qualification to run through the profit and loss and notice differences. And then what's nice with, we use Xero, and I'm sure all the other ones are exactly the same, where you can just click on, if you see the stationery is £500 and you think, what on earth do we spend on £500? And you click on that, and then it just comes up with, this is what the £500 is made up of. And then you can kind of see, okay, forgot about that, or that doesn't look right. And then you can interrogate that further.
Yeah, exactly. I don't know, people sometimes think there are some sort of special techniques for this, which, and at scale there would be, analytical review things, but in terms of small business accounts, you just run down there with a finger with a ruler just to make sure that you think
keep it simple.
Yeah, exactly.
Yeah. Greg, any other pearls of wisdom from you in terms of what clinic owners can do to kind of just be on top of their accounts?
I think so. I think you've covered it pretty well. Probably having a routine, because I think a thing that's harder for one of a bunch of things that makes running a clinic a bit different for some of the businesses is that you haven't usually got the external. You're not obliged to update everything at least quarterly, whereas a normal VAT registered business, at least every 3 months, they've got to make sure the records are in some semblance of being meaningful. Yeah. So I think doing it little and often is a good thing. A bad thing that you see sometimes is clinics where nobody really wants to do it, so they share it around. So sometimes somebody will go into Xero and do reconciling. Sometimes somebody else will do it. That's almost always a catastrophe. We've got one business I can think of where there's 4 partners in it, and each quarter a different one is responsible for getting the stuff up to date for the VAT return, and it's really stupid. What can you do? So I think consistency, little and often. At least then if you're doing something wrong, you'll be consistently doing it wrong, which is much easier for an accountant to fix and much easier for somebody to spot.
Yeah.
Whereas if you tend to think, oh, I'll come to it when I've got time, and that's not very often, then you'll probably do things wrong in a different way each time.
Yeah.
And that's far harder to fix, and can make the reports less meaningful still. And probably, I guess, also talk to your accountant about how that routine might work, because I mean, you'll know in Xero there's a bunch of stuff you can do about setting up rules and so forth to make the thing pretty smooth. And if you've not looked into that and just sort of blundered into like giving it a go, sometimes you find people are doing, maybe people see me doing it, sometimes look at my shoulder and think, why is Greg clicking there, then there, then there, then there, when he could just go straight to the button. So maybe have a chat with your accountant, but okay, well, how can you just give me an hour's like input, share your screen and show me how I should use this.
Yeah, I think that kind of comes back to our conversation of actually get onto an accounting package like ASAP, like don't leave it. If you're starting a clinic, get onto an accounting software system, because but take the time to make sure that it's set up in the way that you want it to be set up, so that it's giving you meaningful information, but it's also saving you time at the end of the day when it's set up properly.
Exactly. Exactly. And again, it's to help you run your business. There aren't right categories even to put things in. If you're particularly interested in a particular area, then fine, have a separate line to track that if you want. And don't think that just because Xero or QuickBooks comes with a bunch of standard codes that somehow you're under pressure to use them all. We'll just delete a bunch of them to begin with when we're setting one up, because they're not going to be appropriate for the type of business that we're looking at.
That is something that clinics want to be able to see more easily, is almost like different cost centers as well, but also your revenue minus your cost of sales. So we want to be able to see how much is physio bringing in, how much is physio costing us, how much are products bringing in, how much are the products costing us. So that's, I know you can set that up all up on Excel, but equally you can set that up in accounting package software so that you can get really meaningful reports.
And it'll be easier. It'll be easier software for sure. And I mean, it sounds, when you describe it that way, somebody might think, oh, that sounds really daunting. It's going to be a lot of work. But it's probably one of these things where, to begin with, it might seem complicated, but then you come back and say, fine, there are like 2 or 3 key. This is the thing we have to look at with products. This is the thing we have to look for physio. So sometimes things can seem complicated, but then you realize, it was simple. It was simple all along. That's what we need to aim for.
Yeah. Greg, I don't think I've got any other questions for you, and I just want to thank you so much for joining me today. How can anyone get hold of you? And I will put this on a slide at the back of the interview as well, but how can people get hold of you? What's your best contact preference?
So they can go to the website, which is www.fizzhq.com, fizzhq.com, and there's a contact form there. They can just fill that in, and that will come to me, and we'll be pleased to hear from them.
Perfect. Thank you so much for your time today.
You're very welcome.